Hi everybody, my name is Ryan Henderson and I am a tutor at Phoenix Financial Training in Dubai. This is the third question that I want to go through with you from past exam questions where I think it requires a little bit of practice for these specific topic areas. Now again, the question that I want to go through with you is a past exam paper and it is from March and June 2016. So here you do have your PDF question and answers, but as I said to you in the previous videos, this is not the correct Finance Act that we're working to. So therefore what I have done again is created the question and got this question under the current Finance Act. Now, if you haven't got access to this question, I would pause the video here and then have a little read through of this question. But as I said before, any of these past exam questions should be in any exam kit that you have to hand under the current Finance Act. So what we are going to do here is attempt this question on Excel. As I've said to you before, if you are practicing questions that are not on ACCA's website, you can still use the practice software that is here, the CBE software that is available for you. So when you are practicing questions out of your exam kit and you want to practice using the ACCA CBE software, you can do that here on your constructed response workspace. Now, I have already typed up the answer to this question here, so you can see all of the detail and you can see what is required of you in this type of question. So the first thing we will do is read the requirements. This is a 10-mark section C question. It's asking you to calculate the inheritance tax that will be payable as a result of James's death and state who will be responsible for paying the tax. That's the first bit for part A. Part B, explain why it might have been beneficial for inheritance tax purposes if James left a portion of the estate to his grandchildren rather than to his children. And then C is explanation again, why it might be advantageous for IHT purposes for a person to make lifetime gifts, even when such gifts are made within 7 years of death. So the requirements here, guys, are very, very simple. You have some calculation, you have some explanation. In part C, though, your answer should include a calculation of his inheritance tax saving, making the gift from the property to the trust on the 2nd of August 18 rather than retaining it until death. You are not expected to consider any lifetime exemptions in this part of the question. So, as I've said to you before in the previous recording and the previous videos about taxation, inheritance tax, there are tricky areas and it is literally a case of learning the rules and learning the steps that you have to follow in this question to get the right answer. And inheritance tax is all about dates. It is very, very specific, very, very important when you are looking at your dates here. So if we go through this, the first thing I would do in any inheritance tax question is identify the date of the death and 7 years prior to that death, because as we know, any lifetime gifts that have been gifted within the last 7 years, guys, do become chargeable. So therefore we have to make sure that we look back 7 years and we know those dates. Then what we have to do in part A is calculate any IHT that will be payable on any of those lifetime gifts, and also, of course, as a result of James's death, there could be and there will be items also in the death estate. So what we're now technically doing here, guys, is technically computation number 2, and this is any tax that will be payable on those lifetime gifts within the last 7 years, and you always have to go in date order, remember. So the 9th of October 2012, we had a CLT. Now the CLT, there is no additional tax to pay on this because it is more than 7 years old. However, as we know, a CLT is taxable in lifetime, and even though it's more than 7 years old, it is never going to be completely exempt because it has used up the available nil rate band. So I still have to include it in my calculation here, as you can see. Transfer value minus exemptions, etc., to give you a gross chargeable amount, but no additional tax to pay. So as you can see here, I'm going in date order, chronological order, very, very important. Just move this across so we can see the screen. Then also, on the 14th of May 2018, we had a pet. Now the pet is within the last 7 years, so therefore, of course, guys, we have to calculate our transfer value. Now, if you're looking at this, I am calculating tax payable on lifetime gift, which is as a result of death, which is computation number 2. But rather than doing comp 1 and comp 2 separately, what I've done is I've amalgamated the two together, because the transfer value, or calculating the gross chargeable amount, would normally be calculated in comp 1 in lifetime. Then whatever the gross chargeable amount would have been brought into computation number 2. But you haven't got to waste time by writing them up separately here. What you can do is just allocate them all into one computation and then start doing the calculation. Now you always have to check the nil rate band that is remaining at death. This is always the situation. This is now based on his death tax year. And then you always look back 7 years. Now on tax on lifetime transfers, when you're looking back 7 years, you're looking back now 7 years from the date of the gift, not from the date of death. So as you can see here, we're going back from the 14th of May 2018, which is the date of gift, back 7 years to May 2011. And what this has then done has brought in that CLT, which is no longer chargeable, but it has used up, of course, some available nil rate band. You'll calculate IHT, check for any taper relief. Now the taper relief, of course, is how many years they have survived from the date of the gift. You have to count based on years they have survived. So again, I always say to students here, use your fingers to find the dates and to calculate the years. Very, very important. IHT payable, obviously we had to say who it was payable by and who when it is due. Then there was another CLT, same situation. It's within 7 years. We have to now tax it. We've done comp 1, but we've identified that there are no CLTs remaining, or no, sorry, annual exemptions remaining. Calculate the nil rate band remaining, if any. There isn't any in this situation. Calculate the IHT, and again, identify who has to pay the tax. So you can see here what we've done is we've looked back from the date of the gift, not from the date of the death 7 years prior. Then there is a death estate. Now you can see it told us in the question there is a gross chargeable amount in the death estate, so that's nice and simple. Nil rate band remaining. Now you'll notice here that in the death estate we are looking back 7 years from death now, okay, not 7 years from gift, because there are no lifetime gifts in the death estate. These are all things that are still owned at the date of death there. And as you can see with part A, then what we've done is we've gone through very detailed each one separately, dealt with each one separately, and then moved on to the next one. So hopefully you can see there's a good approach on the way that we would attempt this. Part B and part C is just basically saying explanation for a little bit. If he'd left a portion of the estate to his grandchildren, it would have skipped a generation, so wouldn't have been taxed twice. This is just basically asking you to explain your knowledge rather than doing any calculations. And then part C, the value of the asset would be frozen at the date of gift. This is an advantage, of course, of gifting in lifetime. Annual exemptions would be available. Taper relief would be available as well if they had survived at least 3 years since the date of gift. And then it did ask you to calculate a tax saving there. Tax saving, very simple calculation. Whatever the value has increased by minus what it was worth, therefore taxed at the rate of 40%. So hopefully guys, with this is a standard inheritance tax question, but it covers lots of areas, and hopefully from this that you can see that you must deal with each gift separately in a chronological order, and approach and organization is very, very important with these style of questions. Hope you found this video useful, and good luck in your exams.